It is time for our Dollars and Cents segment, which is a way every week we bring you a good financial tip to help you improve the quality of your life as you're in retirement or as you're getting close to retirement. And today, I want to talk briefly about the potential tax increase we're going to see in 2011 and what that means for you. The Bush tax cuts of 2001 are set to expire at the end of the year. There has been some scuttlebutt about Congress working on this problem, but I don't know. I'm not terribly optimistic they'll get something done, but they very, very well may. Bottom line, if nothing happens, we are going to be looking at one of the largest tax increases in U.S. history, and it is not just on people making over $250,000 a year. That is something that the presidential administration and Congress are working on to try to extend the tax cuts for earners of less than $250,000. But I don't know. There's a lot of dissension and a lot of disagreement on how to do that in this budget crisis that we have. So if the tax increase goes into place and we sunset back to the tax law before the 2001 tax cuts under President Bush, here are just a few things. The lowest bracket for personal income tax will increase from 10% to 15%. And they say, well, that's a 5% increase. Well, no, it's a 50% increase. Going from 10% to 15% is a 50% increase in your taxes, and that's in the lowest tax bracket. The 25% bracket goes to 28%, which is about a 12% increase. The 28% bracket goes to 31%. The 33% bracket goes to 36, and the 35% bracket goes to 39.6. So it affects everybody, and for many of those levels, those brackets kick in at earlier amounts. In other words, those brackets kick in earlier, so you might be in a 25% bracket now. That bracket's going to 28, but then based on your income, you could actually be in 31. Because the bracket kicks in earlier, if that makes sense. The capital gains tax on long-term gains is going from 15% to 20%. Again, that's not a 5% increase. As a percentage of the tax you're paying on your long-term capital gains, that is a 33% increase. Taxes, the biggest one is taxes on qualified dividends they're going to be treated starting next year as ordinary income, whereas right now they're treated at 15%. They could now be treated in 2011 as high as 39.6%. And the marriage penalty is also scheduled to be reinstated in 2001. So now that may not happen, but at this point I'm kind of figuring it very well may happen because nothing's been done. We also have the estate tax coming back at anything over $1 million. How do you plan for this? Real briefly, the biggest thing is you do need a plan to deal with this income tax situation. It might affect, for example, with Roth conversions. If you do a conversion this year, you may not want to spread your taxes into the next 2 years. You may want to pay them all this year. There's so many things that come up. You can be efficient with how you're handling your mutual fund gains and losses. There's a lot you can do with year-end tax planning. So you need a plan is the biggest thing. The tax man is very powerful. We've always heard it's not how much you make, it's how much you get to keep. So you need a tax plan as part of your comprehensive financial plan. The other thing is because of the issues with our federal debt and our deficits, I just think it is going to continue this thing we're seeing over the last really 10 plus years of economic instability, of booms and busts. And so I think as we continue to see these dramatic rises and falls of the market, you've got to have a plan for dealing with that kind of volatility. So that would be my tip, is to have a good plan for dealing with the tax issues and dealing with the potential instability of the markets based on how